It is generally easier to manage something that is measured, and this is certainly true for risk. Measuring risk enables bank management to assess the potential impact of strategic decisions and business plans, set risk appetite and define risk acceptance criteria, assess individual risks, compare different proposals, and make more informed risk decisions, calculate and report risk exposures, compare actual exposures with risk appetite, develop and apply stress scenarios to risk exposures, demonstrate regulatory compliance, and provide transparency to shareholders and interested third parties. But measuring risk is not always an easy task, particularly when looking at different risk types. The ability to measure risk varies considerably by risk type. One way to visualize this is to place risk type on a scale from easiest to measure to hardest to measure. Some financial risks, such as credit, market, and liquidity risk, are relatively easy to measure. On the other hand, some non-financial risks, such as operational risk, are far more difficult to measure. The main determinant for ease of measurement is whether there are objective measures of risk available. For example, measuring settlement risk is fairly straightforward as it is the sum of value of contracts due for settlement on a particularly value date. But there is no such equivalent for reputational risk, which makes this type of risk extremely difficult to measure. Even within risk types, the ease of measurement can vary depending on what is being measured. In the case of credit risk, for example, it is not always easy to determine the probability of default for some types of exposures, such as a project finance loan for a dam under construction. In such cases, a qualitative measure of risk is often used, but this can be very, very subjective. The wide scope of one risk type in particular, namely operational risk, creates a significant measurement challenge for banks. Operational risk incorporates internal and external fraud, operational failures, and human errors among other operational risks. When combined with the wide range of measures available, only some of which are objective. Operational risk measurement has proven to be particularly challenging for banks. Some of the risk measurement limitations include the completeness and quality of data inputs, the time lag before risk measures are reported, model risk, and also the inability to aggregate different measures to produce a single measure of risk. Staff responsible for monitoring risk exposure and making risk decisions must be aware of these limitations in order to avoid interpreting data incorrectly and making inappropriate decisions. So, what should be measured? A variety of measures are available to banks to measure different aspects of risk. These include exposure, the level of risk to which a bank is currently exposed to, gross exposure, so the value of an exposure, net exposure, the gross exposure less the estimated value of mitigation, and potential exposure, so possible future exposure, which might include maximum, minimum, and most likely values, as there may be a range of possible outcomes. Probability, the likelihood that one or more risk events or possible outcomes will occur. And finally, volatility, the extent to which a risk measure could vary from a current value expressed as percentage of standard deviation over a given time frame. These different measures help bank management to address questions such as what is the current risk exposure, what is the potential risk exposure should risk event X or Y occur, what is the likelihood that X or Y could occur, what is the likely and worst case scenario should X or Y occur? In short, such measures provide information on current exposures as well as probability of possible outcomes, the impact of possible outcomes, and volatility. Care is needed when using these measures as there is generally some estimation of scope for errors. Thanks for watching, and I'll see you in the next session.